Welcome back to the deep dive. Today, we're really digging into Target's latest Q2 earnings. Forget the quick headlines. We want to pull apart the numbers, see what they actually reveal about this huge retailer, and, what it means for how you understand the economy and what consumers are doing. So, looking at these results, what's your sort of immediate take on the Q2 numbers?
Well, the big headline for a lot of people was better than feared. Target's revenue landed at $25.21 billion. Now, that was a slight drop, 0.9% year over year, but, and this is key, it actually beat the analyst estimates, which were around $24.9 billion. So, yeah, it's still a contraction, but maybe not as bad as the market was kind of bracing for.
Right, better than feared. And that seems to apply to comparable sales, too, doesn't it? They were down 1.9% year over year, which, again, sounds bad, but analysts predicted worse, like a 3.1% drop. But when you look closer, there's this really interesting split. Physical store sales dropped 3.2%. Both traffic and the average basket size were down. But then digital sales, they grew 4.3%. And those same-day services, like Drive Up, surged over 25%. Digital's now, about 19% of total sales? What does that specific breakdown tell you? Where are they winning and, where are they still struggling?
Yeah, it tells us quite a bit about the consumer, actually. Despite those less bad beats, the underlying story is, I think, still one of pretty weak demand, especially for discretionary stuff, the non-essentials, particularly inside the actual stores. The digital growth, especially same day, that just screams convenience is king for shoppers today. Absolutely critical. But this mix shift, it put real pressure on margins, more lower margin sales, plus they had to clear out inventory. So their gross margin fell a whole percentage point. That's 100 basis points, down to 29.0%.
Wow, a full point.
Yeah, mainly because of more markdowns, canceling orders. They did have some things helping, like lower shrink, less theft or damage, and growth in their ad business, Roundel. That helped offset it a bit. Operating margin was also down to 5.2%. So the investor takeaway was clear. Okay, better than feared, sure, but still very much a contracting business overall.
That makes sense. So, okay, with those financials as background, let's unpack what shoppers are buying and maybe more importantly, what they aren't. What's the category breakdown telling us about consumer habits right now?
This is where you really see the strategic shifts happening.
Yeah.
On the positive side, hard lines were up 6%. That's things like electronics, seasonal stuff, back to school. Food beverage also saw a small increase, 0.9%. That points to pretty stable, value-driven demand people need to eat. And beauty was up slightly too, 0.4%, which is a really resilient category. Fits that whole affordable luxury trend, right? People still want small treats.
Okay, so needs and smaller indulgences are holding up. But what about the weak spots? Where did Target really feel the squeeze?
That's the crucial difference. Home goods, down 6.3%, a big drop. Clearly shows that pullback in discretionary spending after the pandemic buying spree.
Yeah.
Apparel was also down 4.1%, hit by markdowns, and frankly, people just not shopping for clothes as often, it seems. But the one I find most concerning really is essentials being down 3.1%.
Essentials like groceries and toiletries.
Exactly. This suggests Target might actually be losing some market share there, maybe to places like Walmart, Costco, even Amazon, probably because of perception that prices are lower elsewhere for those basic items. And this whole mix shift, moving away from the fun stuff towards just needs, it highlights a really critical point for Target. They seem to be losing that discretionary trend factor, that sort of Target magic that was such a big part of their brand. It's a challenge to their unique identity, I think.
That's a huge point, losing that discretionary trend positioning. Like, they're not the automatic place you go for those fun impulse buys anymore. But let's pivot to something that looked, pretty good. A bright spot may be hidden in the details. Non-merchandise revenue. That segment jumped an impressive 14.2% year over year, reached about $1.04 billion in Q2. And specifically, you mentioned their ad business, Roundel. It surged 34% year over year, $217 million. Highly profitable and growing faster than Amazon's ad business, relative to its size anyway, plus double-digit growth in membership and marketplace revenue. Why is this detail so fascinating for investors?
Look, it's fascinating because it's more than just a buffer against weak retail sales. It really signals a potential strategic pivot. Target isn't just selling stuff off shelves anymore. They're using their stores, their website, their customer data. They're becoming a platform.
A platform, interesting.
Right. This move into advertising, memberships like the new Target Circle 360, the marketplace, it's not just about adding revenue streams. It's potentially redefining what Target is. These are typically higher margin businesses, so it could build a much more resilient, maybe even higher margin business down the right. Could they be the next big retail media player? Definitely one to watch.
Yeah, that's a compelling long-term picture. Now, you mentioned the paradox earlier, digital booming while stores are declining. Digital comparable sales up 4.3%, kind of offsetting the weak store performance. And that huge over 25% growth in same-day services like Drive Up and Circle 360 is really something. And it leans on that structural advantage, right? That stores fulfill almost everything, like 98% of sales in store, pickup, ship from store. But you mentioned a potential risk there. What's the important question this dynamic brings up?
It brings up a really critical question about sustainability, I think. Okay, great, the stores fulfill almost everything. But if those physical store comparable sales keep falling at 3.2% year over year, well, Target risks undermining that very strength unless the actual in-store experience gets dramatically better. And I mean things like, are the shelves stocked? Is it clean? Is it easy to shop? If that foot traffic keeps dropping, it could become a much bigger drag on the whole operation. We've all walked into stores that look like, a mess, right?
Yeah.
It really impacts whether you want to be there.
Oh, absolutely. Those little things make a massive difference to the shopping experience. Okay, let's shift gears slightly. The balance sheet. What do the numbers tell us about Target's overall financial health?
Right, the balance sheet. So cash is at $4.34 billion, which is down from last year. Inventory is pretty flat year over year, around $12.88 billion. Long-term debt is up, though, year over year to $15.32 billion. Their return on invested capital, ROIC, was 14.3%. That's down from 16.6%. And if you strip out some one-time gains, it was probably closer to 12.9%.
And buybacks.
Yeah, notable that there were no share buybacks in Q2, even though they have $8.4 billion authorized to do so. They did pay out a good chunk in dividends, though, $509 million. So they are still committed to shareholder returns that way. Free cash flow was about $500 million year to date, but that's after heavy capital spending on remodeling stores and tech investments.
So what's the investor takeaway from that?
I think investors saw that capital returns were a bit muted,
Mhm.
and the focus now is really on liquidity and being disciplined with that capital spending. They want to see that these investments in stores and tech actually start paying off, in better results down the line.
Okay, now for the really big news. Maybe bigger than the earnings themselves, at least in terms of headlines. The leadership change. CEO Brian Cornell, after 11 years, is stepping down February 1st, 2026. He'll stay on as executive chair. And his successor is Michael Fiddelke, the current COO. He's a 20-year Target veteran, credited with big things like supply chain improvements, digital growth, cost cutting. He recently launched this enterprise acceleration office focused on simplicity and speed. And Fiddelke laid out 3 priorities: getting Target's merchandising swagger back, fixing store execution stocking, cleanliness, and investing more in tech. How did the market react to this choice, an internal hire?
Yeah, this is where the market reaction gets really interesting. And honestly, it was pretty clear disappointment. I think a lot of investors were kind of hoping for someone from the outside, a disruptor maybe,
Yeah.
to come in and really shake things up, spark a bold reset. And instead, they got continuity and internal promotion.
And that drove the stock down.
That seems to be a big reason why the stock sold off so sharply, like 10, 11% on the day, even though the earnings were technically okay or better than feared. While some investors might have wanted that outside disruptor, choosing Fiddelke, an insider, it does signal something important, if less flashy. It suggests Target's board believes the path forward is through stability, deep operational know-how, and fixing things from the inside out, rather than some radical, risky overhaul. They seem to think the core issues are execution and brand focus, not a fundamentally broken model. But yeah, the market message was pretty blunt. Until traffic and comp sales turn positive again, Target's going to be seen as kind of stuck, a stagnation story, not a recovery one yet.
Right. So let's really get into that. Why did the stock take such a beating today, even with those better than feared numbers? I mean, stock was already way down, right? Like 60% off its 2021 highs, down 22% this year, even before today, then another 10, 11% plunge. What's really driving that investor sentiment?
Well, I think for investors right now, just beating expectations isn't enough, especially when those expectations were already pretty low. A slight beat doesn't really inspire confidence when the underlying growth picture is still so questioned. There's just significant skepticism, I think, about whether an internal hire, even a respected one like Fiddelke, can truly reignite growth versus just stabilizing things.
So it's more than just the numbers themselves.
Exactly. The reasons for the drop are kind of layered. First, like we said, the leadership change signaled continuity, not the disruption some wanted. Second, the quality of the earnings beat wasn't great. It was on lowered forecasts, sales and traffic are still down, margins are still squeezed. And third, there's this broader sort of sentiment overhang. You've had 4 years of stagnant sales, some erosion in customer loyalty, and let's be honest, many people feel the stores have gotten messy. So investors look at all that and they just don't see a quick fix. They're looking for a clear sign of renewed growth, and this report, plus the succession plan, didn't really provide that spark.
Okay, that paints a pretty challenging picture. Lots of moving parts. So looking forward, what does this all mean for what happens next? And maybe more importantly for our listener, what should you be watching if you're trying to figure out Target's path from here? What are the key things to track?
Right, if you're watching Target's story unfold, there are several really critical things to keep an eye on. First, obviously, comparable sales and traffic trends. Will that store traffic down 1.3% this quarter flatten out, or ideally turn positive? That's absolutely essential. Second, markdown reliance. Are they having to discount heavily just to move products? Seeing sequential improvement there would be a really good sign for gross margins. Third, that Roundel ad growth. Can they keep up that impressive 20–30% plus year-over-year pace, especially heading into the holidays? It's such a key high-margin area now. Fourth, the new membership program, Target Circle 360. How does it perform versus their traditional credit card? Can it actually make up for weaker credit card use? And finally, cash returns. Will they start buying back shares again, given that big $8.4 billion authorization they have sitting there? That would signal confidence. So you can kind of see two paths, right? A bull case and a bear case.
Lay them out for us.
Okay, the optimistic view, the bull case, is that store traffic stabilizes. Maybe discretionary spending picks up a bit. They get that merchandising swagger back, maybe with some cool holiday collaborations. And Roundel, the marketplace, the membership program, they all continue to scale up nicely. Shrink keeps falling.
Yeah.
And yes, buybacks resume. That's the positive story. The pessimistic view, the bear case, is that store comps stay negative. Traffic keeps declining. Discretionary spending stays soft. Markdowns continue. Maybe the brand perception weakens further. Loyalty keeps slipping. Cash flow gets tight, delaying buybacks and keeping pressure on the stock price.
So where does that leave us overall?
Overall, look, Q2 wasn't a total disaster. But the underlying challenges, those headwinds, they're definitely still there. The next 2 or 3 quarters are going to be absolutely critical. For execution on merchandising, on the store experience, for how they perform over the holidays, and for those decisions around cash flow and buybacks. The narrative has really shifted. Target isn't really seen as a growth story right now. It's more of a turnaround play, maybe a value play. Investors are basically weighing the execution risk. Can they pull off this turnaround against the potential upside if traffic does stabilize and they truly get that unique Target appeal back?
It certainly gives you a lot to chew on. You know, what impact does a leadership change like this, especially an internal one, really have on a company's ability to innovate and transform when facing these kinds of deep challenges? And just how quickly can a giant retailer like Target actually reclaim its swagger in what is a fiercely competitive market? Something to think about.
Absolutely. Understanding these dynamics, how strategy, execution, and perception all interact, it's key to making sense of the business world around us.
And just a reminder, we are not certified financial advisors, and this content is only for educational purposes. If you are considering making any investment decisions, please consult a certified financial advisor. Thanks so much for joining us on this deep dive, and we encourage you to keep exploring.